Welcome back to the Miami Real Estate Podcast powered by Cervera Real Estate. Today, we have your economic insights with Dr. Marci Rossell, Chief Economist, leading real estate companies of the world.
Hi, everyone. September Economic Insights with Dr. Marci Rossell commences now. And what a week it has been. And what a week it will be next week. This was a big week for the United States. And I think we want to start there. So I was shocked, Marci, by the news that we went a full 50 points. I had money with friends on 25 coming at us. So talk through what that decision means, where it came from, and your thoughts on the impact going forward.
Sure. Well, I got to tell you, Jess, anyone who has watched us talk over the last couple of months knows that I too was in the 25 basis point camp. You were not alone. I was right there. And so when I forecast incorrectly, I try to own up to it. And this is one of those moments where the Federal Reserve surprised you. They surprised me. I think they surprised markets around the world. And this was not a decision that was made without dissent. So you and I were in very good company because there was a governor, someone who is a voting member of the FOMC, Michelle Bowman, and she dissented on this decision. She would have preferred a 25 basis point cut. And it's notable because it is the first time in almost 20 years since 2005 that a voting member of the FOMC has dissented in a decision. So typically, the Federal Reserve likes to give a united front. They tend to all vote together. And this time around, there was a governor who said 50 basis points is too much and would have preferred 25 basis points. So it's a little bit shocking. You and I are in good company, I think, in many ways, but it is important to note that typically the Federal Reserve doesn't make such a big, bold move unless there is some sign that the economy is in crisis. Now, that has led some folks to say, well, maybe the Federal Reserve knows something that we don't know. Maybe they have access to data that we don't have. Maybe they know there's something big and bad out there that we are not aware of. And I want to make clear that all the data that's out there is out there. We will not know for another 3 weeks when the Federal Reserve releases its minutes of its meeting. So we have a statement, but we don't have the actual detail, the minutes. They wait for 3 weeks to deliver that. And I will be very interested in parsing those minutes for insight on their decision-making process. Because I got to tell you, in reading what they have delivered, in listening to their remarks at the press conference after their decision, I didn't really hear anything sort of powerful around this is why we went for 50 instead of 25. I didn't hear it, and I'll be very interested to sort of get some insight into their reasoning in another 3 weeks.
Yeah, as will I, especially since there are other things afoot in the United States right now, given November. So it feels interesting and weird, and we will all review the minutes and talk in October about findings there. So let's talk about sort of what we think the impacts here are. Let's talk with the immediate. I mean, we saw right away there was, sort of stock market action, mortgage rate action. Talk through that sort of the short-term reactive impact, and then what we think we can go into sort of the bigger, longer-term picture after that.
Sure. Well, obviously, financial markets around the world rallied on the decision. So their choice to go bigger than everyone expected meant that the S&P 500 rallied, the NASDAQ rallied, and the Dow Jones Industrial Average rallied as well. But you can look among those three indices to see what sectors are most likely to be affected, or at least where people are expecting the biggest effects from lower rates to be. Not in old-time industrial stocks that are captured in the Dow Jones Industrial Average. It's only up about 10% this year. But the S&P 500 and the tech-heavy NASDAQ are up 20% and 22% this year, which suggests that it's the frontier of the economy, those high-tech stocks, particularly stocks that are most speculative, that will benefit from lower rates. And then obviously, there are mortgage rates. And so mortgage rates have moved off of their 7% plus highs down to 6%, which we haven't seen in quite some time. And I think the big drop in mortgage rates is because you're coming off, number one, that refi risk that we've touched on a couple times, but maybe it's worth reviewing if anyone sort of been with us to hear us, that basically when mortgage rates get above, say, 5%, and it's not exactly clear what the exact trigger point is, but somewhere above 5%, at that point, any mortgage that is taken out at a rate above 5% is exposed to refinancing risk, which means any investor who buys a bond that is backed by mortgages where the interest rate is so high that we know they're going to refinance in the future, that carries a risk that investors want to be compensated for. It's called refinancing risk. And so mortgage rates tend to sort of increase steadily, but when refi risk kicks in, mortgage rates get this upward sort of J shape to them. And so we find ourselves where they move upward slowly and then suddenly, whew, they take this big jump up. And that's because of the refi risk. So now that rates are rolling down, refi risk becomes less of an issue. So that kind of goes away. And so we move back into normal declines in mortgage rates as interest rates overall will decline as the Federal Reserve continues to cut rates. Markets are expecting that by the end of next year, the Fed funds target rate will be back at 3%, which means a mortgage rate of somewhere between 5 and 6%, which gets us back to pre-COVID normal. And maybe that's the message for today, that the Federal Reserve has finally sort of indicated that all of the economic disruption that we dealt with in 2020, 21, 22, and 23, all of that is gone. And we are now back to the world as it will be going forward. COVID is kind of all washed out at this point.
Marci, at the beginning of the year, you said, guys, it's gonna be sort of a herky-jerky ride. In fact, I think that was our technical term for the first half. We're entering a new phase here. I mean, this is a big shift. What can we anticipate, both, our real estate realm and the impacts there from mortgage rates, but also from our consumers' standpoint, and what you think sort of their psychology is going to be now as we head into the last quarter of 2024 and into the first half of 2025?
Well, there are two things that I want to discuss around this particular issue. Number one is that the effects of mortgage rate lock-in are rolling off as interest rates come down to something that's more normal, right? And as we get farther and farther away from the 3-4% mortgages of 21 and 22, that lock-in effect that has had an incredibly disincentivizing effect on sellers in particular. There is a new paper that's just been released from the Federal Housing Finance Agency, right? I had to look at my notes really quickly. You guys know I don't normally take notes, but I'll show you my little cheat sheet.
You're in Paris, you get a pass, Marci.
So I had to take a few numbers, right? But I was fascinated by this paper that came out in August of 2024. So you and I always like to share with everybody the more academic things that we are reading, because it's important to note that you and I don't just drag our statistics off of Instagram or TikTok. We actually look down at the original sources. And so according to these economists who looked at the lock-in effect, basically the average loan has a fixed rate right now that is about 2.5 percentage points lower than the prevailing rate, right? So basically they quantified the lock-in. They quantified it and they basically said that when we look at it, there were 1.72 million fewer sales over the last 2 years because of this lock-in effect. 1.72 million fewer homes sold. That basically affects every single person who is listening today. You have felt it, and now they have quantified it. But what was most interesting is they looked at it geographically and came to the conclusion that, of course, California was the most affected state by the lock-in. It had the most depressing effect on housing transactions in California. But there were some surprises. Dallas-Fort Worth metro area also affected heavily. Phoenix also affected heavily. So for those of you in some of these metropolitan areas where the lock-in effect has been disproportionately disincentivizing, as interest rates come down, you're going to feel that effect go into reverse. It means there's a lot of pent-up demand in your environment. And I would encourage you, for those of you who encounter people all the time who say, I wish I'd bought a house 5 years ago. You need to look at them and say, you don't want to have that feeling again 5 years from now. And that is the reality, is that we are moving back into normal markets, and you are going to see a flood as interest rates come down.
Which is incredible, because when we had our huge spike during COVID, nobody, well, maybe a few people, but most people were not anticipating this. I mean, that was so shocking. And some people are like, oh, I need to catch up. I'm not prepared. This is a moment now, folks, when Marci is telling you, line it up. Talk to your consumers. We have this vision. We have this roadmap ahead of us. It's incredibly powerful.
And they found that the lock-in effect was most significant for luxury buyers. The most affluent buyers felt the lock-in effect, particularly when they were owning high-dollar homes and on the verge of downsizing. So if you're looking to sort of think to yourself, okay, who do I need to target? Who do I need to look at? It's those folks who were sort of in the moment in their lives, in the life cycle, where they've got the big home, they're looking to downsize. They don't want to downsize they want to downsize to save money. Well, when mortgage rates are 7%, they were downsizing and paying more by the month. So now this is the moment for that group.
So shifting gears just a little bit, but just so that we have the full picture, it sounds like there's going to be some relief with inventory. It sounds like we are definitely going to be seeing, some relief on the mortgage side. What about, other factors here, jobs and just overall economic impact for consumers? Could that be an area where the feds were like, oh, we maybe need to protect here, or are we going to remain stable? What is the risk here, Marci, with other areas of the economy?
Well, I think the Federal Reserve was saying loud and clear, even if they kind of mumbled it a little bit, right? They mumbled the language, but their actions were speaking loud and clear, that they are more concerned about the threat to employment in the US right now than they are concerned about the threat to inflation. We forget that they do have a dual mandate. They have a mandate to keep inflation low and a mandate to support strong labor markets, right? So they do two things, and sometimes those two things can be in conflict with one another. So it can be a moment where inflation is still high and they need to lower rates because markets are weak, labor markets are weak, and they can't do it. But now they appear to be confident that inflation has come down enough, that the COVID economy that was driving inflation higher is now in the rearview mirror, and they find themselves in this moment where clearly they are concerned about labor markets. And it is true that the unemployment rate has gone in this country from about 3.5% to over 4%. So there has been a deterioration of labor markets in the US. More importantly, there were, say, 2 years ago, about 6 million people unemployed. There are now 7 million people unemployed today. So a 1 million person increase in the number of folks unemployed in America is meaningful. It has meaning for their lives, it has meaning for the economy, and this is the weakness that they're now concerned about. They don't want it to get any worse. And keep in mind, it takes time for monetary policy to have an effect. So even though you and I are looking at mortgage rates, we're looking at the stock market, the biggest effect on lower interest rates will be 6 months in the future, 12 months in the future. So for those of you who are a little bit concerned that the Federal Reserve was cutting rates in an effort to juice the economy right before an election, it doesn't work that quickly. It simply doesn't. Now, have they left themselves open to that criticism? Absolutely. Absolutely.
It looks fishy, but
the optics are bad. I can't sugarcoat that or sugarcoat it, as they would say here. I cannot do that. The optics are not good. Now, I've told you guys before, I worked inside the Fed. I have friends who still work there. They seek to be as politically neutral as possible. The economy, however, and labor markets seem to have put them in a bind where they felt like we can't wait another 6 weeks. Now, I'm not sure if that's true or not. Could they have waited till their November meeting? Perhaps they could have, but they chose not to. And so they find themselves, I think, you know, basically open to criticism that they acted politically. Now, I'll tell you, I don't think that that's true. I think all we can do is listen to what the chairman said. He said, I don't favor any one politician over the other. And that has been true historically. We talked at length the last time that there's really only been one instance where we can show that a president actually affected monetary policy, and that goes back to Richard Nixon.
Right.
I wasn't even in school yet, so that doesn't count. I was just barely born.
All right. So, Marci, one other question in terms of impact direct for our vertical. Is this going to help? We've been riding on new inventory as a market just to sort of get us through this. Is this going to help juice some new inventory, some building as well? And hopefully too, I mean, we've been seeing a lot of rentals on the market. I'm hoping that we can start seeing, some more building outside of the rentals as well.
Well, this was, underbuilding was a problem that's been 40 years in the making.
Yeah.
And it got worse in 2008, 2009. We've never returned to the level of building that would be necessary to adequately house Americans. So higher interest rates over the last 2 years certainly have not helped, because we know you cannot get away from supply and demand, and interest rates are the price of capital, and builders need capital to build. So when the price of building comes down, when the price of materials comes down, when all those things come down, certainly if economics is still true, and it has to be, otherwise I don't have a job. If economics is still real, then this must spur home building. As rates come down, capital becomes cheaper, inflation remains low, which means the price of lumber, the price of garage doors, the price of appliances, all those things that spiked during the COVID years goes back down to normal levels. All of this supports healthier home building to bring some balance back to housing markets.
So let's start with, reverberations globally from the U.S. activity, the Fed cut this week. What are you thinking that we're going to see out around the world?
Well, the Federal Reserve had telegraphed their move for weeks now. At Jackson Hole, Jerome Powell had said the time has come for lower rates. So the degree to which they lowered rates was a surprise, but the fact that they lowered them 25 basis points, 50 basis points, on the grand scheme of things, that wasn't going to rock financial markets, and it didn't. But what I will say about markets around the globe, for the last 4 years, everyone had been sort of gearing their monetary policy and their fiscal policy to deal with COVID. It was physical liberalization around the globe, everyone doing whatever they could to support their economies through that deep, dark time. Then Russia invaded Ukraine, which dealt a second economic blow to the European continent because of high energy prices, which means governments across Europe have had to take steps to support their consumers through higher energy prices, which means you've had several years of very loose liberal fiscal policy, in addition to very loose monetary policy, which means we've seen higher interest rates around the globe. Now, this is coming home to roost in the form of difficulty making their budget targets, particularly in France, where I am right now. The headlines everywhere are that France is once again busting through the European Union's budgetary limits, and they're going to have to be cuts somehow in the future, so to right their economies. Same thing's going to happen in the US as interest rates, carrying costs have gotten so high. But now we're moving back to a situation where countries are basically adjusting their monetary and fiscal policy to meet the normal economic realities of their countries. So for instance, you have a Chinese economy that is still incredibly weak, suffering from a deep housing crisis that you got to realize, my friends, is in its fourth year. Fourth year of housing market declines, price declines in the Chinese economy. So their economy is suffering. They need a different loose monetary and fiscal policy as opposed to the US economy, which is almost the reverse of what you're seeing in China, where the US economy is growing at 3%. Our labor markets, while they are weakened, are nowhere near as weak as you would call recessionary levels. And so this calls for a different fiscal policy, certainly, and an adjustment to monetary policy as inflation has come down. So we're seeing this divergence of policy across the globe as countries like Japan and Brazil raise interest rates to continue to fight inflation, while countries like the US and even South Africa are lowering their interest rates to deal with lower inflation and threats to their labor markets. So from a global point of view, the globe is no longer moving in sync when it comes to policy. Everybody's kind of going their own way. And once again, it becomes local, right? It becomes a local issue as opposed to this sort of globalization of monetary policy.
I hate to end on a sort of a sour and dark note here, but I do think that we need to address the recent escalation of the war this week with some wild headlines. Are you imagining that there are going to be some global reverberations there? What's the trajectory, Marci?
Well, I have to tell you, I would have expected the disturbance there, the heightening of tensions to cause oil prices to increase. And if you notice, they have not. In fact, oil prices have steadily declined so that we are now sitting with an oil price of $71 a barrel, which for most of the world means, at least in the US, that means gasoline at less than $3 a gallon. So for my global friends—
Not in Chicago, but yeah.
But in New York City, I took a trip to the airport just last week. I was in New York, and on my way to JFK, you can buy gasoline in the city for less than $3 a gallon.
Nobody drives in New York. That's why.
That's true. Nobody drives in New York. But the reality is that the link between geopolitical tensions and global ramifications that used to be so predictable. It used to be that when there was tension in the Middle East, the price of oil skyrocketed, the price of gold skyrocketed, and there was a flight to quality to the dollar and US bonds. What I'm noticing is that that sort of predictable playbook that you could always count on, it's not happening any longer. And so it suggests that things are changing, that oil is responding more to weak Chinese demand than to tension in the Middle East, as the US becomes a producer on par with Saudi Arabia. So all those links that we sort of fall back on and expect to happen. One of the things that the economy has taught me over the, oh God, I can't believe I'm going to say this, but almost, 40 years since I've been an economist, that history is powerful. It is important. I fall back on it very quickly to give me guidance. But when I look forward, I see things changing all the time. And as the world moves more divided between East and West, where it seems as if the globalization that made so many things predictable in the 90s and in the 2000s is kind of unraveling. Different alliances, different economic effects around the globe. And I think that's one of the reasons why we didn't see markets really react to something that people found to be, shocking and surprising.
I'm so grateful for you keeping us apprised through all of this change. And sacrificing some of your time in Paris for us. You're amazing. Thank you. Travel safe. Be well. See you in a couple days. Bye, everybody.
From all of us here in Miami, where the future is always bright. Until next time.